Hi there and welcome to my channel. In this video, we are coming to continue our discussion on Consolidated Financial Statements, IFRS 10. Now, in my previous video, I laid the foundation for IFRS 10, the reason why we have to prepare Consolidated Financial Statements. There, we defined what a parent is, what control is, why a parent might be exempted from preparing consolidated financial statements. We learned and then we also started IFRS 3, business combinations. So we laid the foundation, the basis of what consolidation is all about. That is IFRS 10, consolidated financial statements. So in this video, from this video onwards, what we are going to do is we are going to crunch numbers actually. So we are going to dive deep into crunching of numbers. So to do that, we have what we call substandard workings that we look at when we are doing this particular consolidation. Alright, so I want to introduce you to those standard workings because they are going to be helpful in this particular video. So let's look at them. The first thing that you have to do is what we call the group structure. Now I'll be talking about them in more detail when we are solving questions, so just relax. I just want to introduce you to something called standard working so that when I'm talking about it you can relate, all right. So we have the group structure. The group structure is talking about the relationship that is existing between the parent, the acquirer, and the subsidiary, the acquiree. All right, so that is the relationship. What percentage of shares does the parent have in the subsidiary? That is what we call the group structure. Then we have something we call the net assets of the subsidiaries. I will talk about that. It will be helpful in calculating our goodwill, which is the third standard working, and the non-controlling interest, as well as the group retained earnings, which is the fifth one. All right, so I just want to know something about this so that when we continue you will not be at sea. All right, then other ones which might come later include investment in associates. It is covered in IAS 28, that is investment in associates and joint ventures. We are going to look at that at a later time. And then also when we are looking at consolidated profit or loss, we will look at the share of profit of the non-controlling interest. So these are some standard workings that we are going to use throughout this particular consolidation studies. All right, so let's dive into what we have for today. If this is your first time on my channel, please subscribe to the channel and consider hitting the notification button so you can receive notifications of new videos when I release them. And if you subscriber, thank you very much for sticking to my channel. I really appreciate your time here, and I want you to share the video to as many as you can so they can also benefit from what the Gen Z analyst has been sharing here on YouTube. All right, so we have goodwill. Now I established the fact that IFRS 3 deals with goodwill, recognizing goodwill on acquisition. Whenever the parent acquires a subsidiary, you need to recognize goodwill. Now there is a reason for that. You see, goodwill is calculated as the difference between the fair value of the business taken as a whole. Now I'm going to explain that in a moment, and the fair value of its I'm talking about the subsidiary's separate assets. All right, so the difference between what the parent pays for the business as a whole, that is the fair value, and the fair value of its individual separate assets. So we have this to illustrate that this is the fair value of the consideration. That's the amount of money the parent is paying to acquire the subsidiary. All right, then because the parent is only buying a percentage, usually parents do not buy 100%. That is very rare. They buy 80%, 60%, okay. And I told you the percentage that will give you control, that will make you called a parent in my previous video. So you buy that percentage, which is the majority shareholding, 50 and above percentage holding, and then the remaining is what you call the fair value of the non-controlling interest. That is the value of the portion of the business the parent does not control. So what we do is that we add the fair value of the consideration, or what we call the cost of investment, to the fair value of the portion of the business we do not control, that is the non-controlling interest, and then we have the fair value of the business taken as a whole. So the business taken as a whole, that is its value. Then we are going to find the fair value of the identifiable individual assets of the business, put them together, and then we subtract that value from the fair value of the business are taken as a whole, and then that is what we are calling goodwill. So usually there is a difference between what the value of the business taken as a whole is and the value of the individual assets making up the business. All right, so that is what we call goodwill. I want you to get this very carefully, because financial reporting does not just test your number crunching, it tells your understanding of the concepts within consolidation. So that's what I want you to get. All right, so usually what the price that a parent pays for a subsidiary is not only the value of the assets making up the business, but also other factors, and one of them is what we call goodwill. So, or a major part of that is what we call the goodwill. Now, the goodwill definition and formats that we have here might, instigate some form of questions. Maybe you might be asking. So let's ask, what if the value of the net assets, as we have seen here, the fair value of the identifiable net assets of the business exceeds the fair value of the business as a whole? That can happen. It's not like it is impossible. It happens that the value of the ins might exceed the fair value of the business taken as a whole. That is the amount the parent is paying for the business together with the value of the non-controlling interest. So that can happen, and we call it negative goodwill or gain on bargain purchase. Gain on bargain purchase. So this can happen. All right. So we IFRS 3 business combinations refer to this as negative goodwill or gain on bargain purchase. Now, gain on bargain purchase is usually common, is the most common term that we use. Now, when it is a positive goodwill, it is replacing our cost of investment within the non-current assets portion of the parent's financial statement. Now, you might be confused because you did not watch my previous video. If you watch my previous video, I touched on IAS 27, separate financial statements, where I mentioned that I showed you how a separate financial statement looks like. So when I say the goodwill is going to replace the cost of investment within the non-parent asset portion of the separate financial statement of the parents, then you will immediately understand what I am talking about. So what I'm saying is that the goodwill, the positive goodwill, forms part of your non-current assets in the consolidated financial statements, whilst negative goodwill is taken directly into the statement of profit or loss. All right, so that is, I want you to understand this. We'll get into the calculations and then you understand it better. Okay, now let's go to the non-controlling interest. Non-controlling interest, as I said, is the share of the subsidiary's net assets which is not owned by the parent. That share of the subsidiary's assets that is not owned by the parent, or it is that portion of the business that remains after the parent has acquired a proportion of the business. Alright, so that is it. Now we also recognize it according to IFRS 3 business combinations. We recognize this just like we recognize goodwill at acquisition. Goodwill is recorded at acquisition. Same applies to non-controlling interest. Now there is something I didn't say about goodwill. After we have calculated our positive goodwill, we test according to IAS 36. Impairment occurs when the carrying amount of an intangible asset exceeds its recoverable amount. Now the recoverable amount is the higher value of the fair value of the intangible asset, or the value in use, which is the future value of the asset discounted into the present. I don't want to confuse you with plenty standards yet, so let's just take it at that. So goodwill is subsequently tested for impairment. That is the subsequent measurement of goodwill. We subsequently test it for any impairment, and then if there is any impairment on the goodwill, we subtract it from this particular value here to get our goodwill at the reporting date. Alright, so that is it. So we continue with the non-controlling interest. Now the non-controlling interest, according to IFRS 3, is measured in two ways. We measure it on acquisition by acquisition basis. That is, when you acquire a part of the business, you measure non-controlling interest. When you acquire another part, you measure non-controlling interest. That is the acquisition on acquisition or acquisition by acquisition basis. Alright. Now there are two ways of measuring the non-controlling interest. We can measure the non-controlling interest at its fair value. The fair value will always, if it is measured at fair value, it will always be given to you in a question. If the fair value of the non-controlling interest is not given to you in a question, but that is the measurement method that has been stated, then you have to use the formula: the market value of the share in the subsidiary multiplied by the number of shares owned. Alright, so the share value of the subsidiary at the date of acquisition multiplied by the percentage of shares owned by the NCI. That will give you the fair value of the NCI at acquisition. Now the second measurement method is to measure your non-controlling interest at the proportionate share of the identifiable net assets. Now this can be calculated, or the identifiable net asset amount is calculated on the standard working 2, the net assets of the subsidiary schedule, which we are going to look at in a jiffy. So this is just a brief introduction, and it was just theory that I was talking about it. Now let's dive into the calculation. Let's see how we can put these into practice. Alright, so we go to the first question here, and the first one here we are going to look at when NCI is measured at fair value. When NCI is measured at fair value. So pick a question here. You have an illustration here. Now this particular financial statement of financial position you are seeing here is what we call a separate financial statement. This is prepared in accordance with IAS 27, separate financial statements. I have dealt with that in my previous video, so you can check that out to understand more what I mean by separate financial statements. Alright, so we have the non-current assets here, which comprise property, plant and equipment for the parent and then for the sub. Then we have investment in the subsidiary, which is 1,200 here. Then we have the net current assets. The net current asset is talking about our current assets less our current liabilities. All right, so both for parent and then the subsidiary. Then we have issued capital and then retained earnings. So for this business, we don't have non-current liabilities. That means that the business is an all equity financed business or entity. So we don't have any non-current liabilities. Right, then we have a few additional information here. One, the parent bought 80% of the subsidiary 2 years ago. Subsidiary's reserves are $150,000 at the date of acquisition. Goodwill has been impaired by $200,000 since the date of acquisition. NCI is measured at fair value on acquisition. So NCI is measured at fair value at acquisition. So this is the fair value method of measuring the goodwill of the NCI. Now the market price of one share in the subsidiary at the date of acquisition was 29.60. Now in this particular one, we are seeing that the fair value has not been given to us directly, but the market price of one share in the subsidiary at the date of acquisition has been given to us. So we can use that to multiply. We'll use this particular figure, the market price per share for the subsidiary at the date of acquisition, and multiply it with the NCI's percentage holding in the subsidiary. So let's look at how this is going to be. So we'll have our solution here. This is Microsoft Excel. So I'm going to utilize its computation functionality. So the basic principle of consolidated financial statements is that we replace this particular investment. This is the separate financial statement. So we are converting the separate financial statement which has been prepared in accordance with IAS 27. We are going to replace this particular investment in the subsidiary which has been recorded at cost with the amount of net assets that the company has. So as you can see, this is 1,150. If I add the 50 to this 1,150, I'm getting the 1,200 which the parent has paid for the company. So basically, we are replacing this particular investment in subsidiary with the net assets of the business. That is all that we are doing when it comes to consolidation. So let's dive into it. And what we do is that because the subsidiary has become a part of the parent, what we do is that we add their results together. So you pick the value for an item in the financial statement of the parent and add it to that of the subsidiary. So we come together and then we present the result of the two entities as that of a single economic entity. I hammered on that in my previous video, so you can go and check that out. So we have here, we'll have non-controlling we'll have our NCA here, that is the non-current assets. The first one is PPE, that is the property, plant and equipment. Now if you are writing manually, if you are not using Excel as I'm using, what you do is that you bring a bracket and then you write the value for the parent and then you add the value for the subsidiary. But since I am using Microsoft Excel to make the calculation easy for me, value here 1,000 and then that of the subsidiary 600, so that I can come here under the group column which we have here. I can just do alt equals to add my value for me. So this is Excel, so let me just make it an accounting figure. All right, so we have that nicely done. So we have that nicely done. Now the next item here is the investment in subsidiary. And what we are saying is that we are going to replace that investment in subsidiary with what we call the goodwill. All right, we have what we call the goodwill, and that is going to be calculated using our work. We are going to calculate our goodwill using workings 3. That is the reason why I introduced you first to workings. Sorry. That was the reason why I introduced you to the standard working, so that when I say working 3, you can easily find out that, okay, so this is working 3. Right, goodwill, that is working 3. So that's the third working. So we continue. So we replace it with goodwill so that we will not have this investment in subsidiary, which is in the separate financial statements in the consolidated financial statements. Then the next item is the net current assets. The net current assets. As I said, if you are writing manually, you do just as this one. So with those ones, we have 500 for the parent, and then we have 600 for the sub. So I can come here and then I'll do alt equals. I'll do alt equals to sum those together, and then I have that. So at the end of the day, I can sum these figures together. So let me come here. I'm summing these 3 figures together, and that will give me my total assets consolidated on this particular day. All right, then we'll have the equity portion. Since this is an all equity finance business, we'll just have an equity portion. And for the equity, we have 2 sources of finance here. We have issued capital. You have the issued capital or the share capital, and that when it comes to the equity portion of the consolidation, we only use that of the parent. We only use that of the parent because the parent is assumed to be the owner of this particular single economic entity we are talking about. So we use its equity only. So we'll come straight to the group portion, and then we'll have 100 for the parents, and then also 2,600 for our retained earnings. So let me just name it retained earnings. I'm taking my time to explain all of this to you because we are going to enter into complications. So if you don't understand the basics, then you become confused. Okay, that is why I'm taking my time to explain all of this. So the non-controlling interest value is also part of the equity portion in the consolidated financial statements. So I'll come here and write non-controlling interest, and then that is going to be my workings 4. All right, and then this retained earnings here. So I'm actually making a mistake here. So this value is not supposed to be here for now. So we have our retained earnings, and that is going to be workings 5. So there are 5 standard workings, as we saw previously. There are 5 standard workings. The first one is the group structure, which we are going to look at very soon. The goodwill, the net assets of the subsidiary, which is workings 2, goodwill workings 3, NCI workings 4, and then the group retained earnings workings 5. All right, so now let's go to our workings. All right, the group structure. Now, what's the group structure of this particular business? So we are saying that the parents bought 80% of the subsidiary 2 years ago. So what we do is that we will have our parent here, which is P, and then we'll have our subsidiary, which is S. Now, the parent bought 80% of this particular business. So I can actually use a draw to actually do this, so to make things, so we have something like this. So the parent has acquired 80% of the subsidiary, and so there is left with 20%. Now this 20% is what we are calling the non-controlling interest. The non-controlling interest. This 80 is referring to the parent. Alright, so let me align this so they are aligned. Alright, and then also let me put this at the middle, this is at the top bit. So we have the NCI being 20%. Now this has been acquired 2 years ago, so we can also establish that the post acquisition period equals 2 years. Alright, so that is 2 years. That is very clear from the additional information that we have here. Alright, so that is the group structure. This is how we establish the group structure. Now let's go to the second working, and that is the net assets schedule of the sub of the subsidiary, which are certain as sub. And then when you come here, what we do is that we are going to list the net assets. Now this particular name, net asset, is from the basic accounting equation. We know that the basic accounting equation is assets equals equity plus liabilities. This is the basic accounting equation. Alright, now we are going to make equity the subject of this particular equation. We are going to make equity the subject of this particular equation, and making equity the subject, we are going to have assets being so we will have our assets, and then we are going to subtract our liabilities, and that will give us our equity. So this particular assets minus liabilities is what we are calling the net assets. The net assets, which is also known as the equity. Now let's come to the separate financial statement. We know that this is the equity portion of the business, which is comprising the issued capital and the retained earnings. So these two items is what we are going to use to prepare our net asset schedule. It's as simple as that. So that's what we are going to use to prepare our net asset schedule. And the net asset schedule is that of the subsidiary only. We are not going to use the net assets of the parent in this particular schedule. So what do we have? We will have the net asset schedule. We are going to have our assets at the reporting date. We're going to have it at the reporting date. We are also going to have it at the acquisition date, as at the time the subsidiary was acquired, acquisition date, so that the difference between these two figures will going to give us our movement in this net asset, which is called the post-acquisition profit. Alright, so we have these three columns here. Then the first item there was issued capital. So I'm going to put my issued capital here. I'm going to put my retained earnings. Sorry, the retained earnings here. So we have at reporting date, at acquisition date, and then the post-acquisition, which is the difference. So at the reporting date, what's the reporting date? This is the value that we have separate in the separate financial statements here. That is, this financial statement is presented at the reporting date. Alright. Now in this particular video, is just that this particular hypothetical question, we don't have any dates here. So, but this, the date of the financial statements that has been prepared for us to consolidate is the reporting date. Alright. Then the acquisition date becomes the date on which the acquisition was done. And in this particular question, the acquisition was done 2 years ago. So if we say that the business was acquired in 2020, then that becomes the acquisition date. So 2 years after, that becomes 2022. So 2022 will be the date on which this particular financial statement will be prepared. So let's come here. The issued capital for the subsidiary is $50,000. So I'll put here 50,000. So let me quickly format this place as an accounting figure. Good. So we have at the reporting date, and then at the reporting date, the retained earnings is 1,150,000, as we have there nicely. So that is the acquisition date values. Now the issued capital, nothing has been said about the issued capital, and that is usually the case in most questions. So we're just going to repeat this particular value there, so that the post-acquisition profits for this, or the post-acquisition movement, becomes 0. So with the post-acquisition movement, we take the value at the reporting date and subtract the value at the acquisition date to get this particular value, and that is 0 there. And then for my retained earnings, let's go to the additional information. The retained earnings for the subsidiary. So the subsidiary's reserves are 150,000 at the date of acquisition. This is what we call the reserves, or the retained earnings. Reserves, capital reserve, is the previous term that is used to refer to retained earnings. The most current term that we use nowadays is retained earnings. Okay, so when you see reserves or income surplus or reserves, they are talking about the retained earnings of the business. Income surplus, reserves, or the retained earnings, they are all referring to the same thing. All right, so we have this being 150,000. Then our post-acquisition profits, which I can copy the formula down, Control D, becomes the difference between those two figures, which is $1 million. So we do not have any other information relating to the net assets of the business. We are going to take more complex questions for you to understand what might come here again. Now, what you must know is that in the net asset schedule, all items relating to the subsidiary are treated in this particular schedule. Every item treated in this particular net asset schedule of the business. So any item that will affect any of the net assets of the business, okay, any of the net assets include intragroup trading or intergroup trading, fair value adjustments on non-current assets and all that. Those things will affect our retained earnings, so they will be treated under the net asset schedule. So any item I repeat, that will affect any of these net assets of the subsidiary will be treated under the net assets of the subsidiary, which is workings 2. All right, so let me sum my figures together. So I can sum these together and then copy the formula across using Control R, and then let me bold it to differentiate this. Now this particular value here, total, is going to be used in calculating our goodwill at acquisition. That's why I said goodwill is prepared at acquisition. Sorry about that. So goodwill is prepared at acquisition. Is going to be used to calculate our goodwill directly, and then this post-acquisition profit will be used in calculating our non-controlling interest figure, as well as the group retained earnings. This will be shared according to the proportion of their shareholding. So we'll get to that later. So quickly, let's go to so that is it for the net asset schedule for this particular question. I hope you understand what we just did here. You can rewatch this video again to understand the concepts that I'm laying right here. Now the third working is the goodwill, and that is the focus of this particular video. Goodwill. So to calculate our goodwill, as I already said, let me just go and copy the standard working that I did here so that you can understand what I mean by the goodwill calculation. Alright, so let me copy this. So let me just copy. Alright, so quickly let's put in the figures. So let's put our level of aggregation here. You know that this is in millions of thousands of dollars, so thousands of dollars. Okay, now what is the fair value of the consideration? That is the amount we paid to acquire the subsidiary, and that amount is this particular amount here, 1,200. Alright, so we have 1,200 there. Then what is the fair value of the non-controlling interest? What is the fair value of the non-controlling interest? That's the NCI. So there we know that if it has not been given directly, we calculate it using the percentage of the non-controlling interest, and that is 20%, as we have already established in the group structure. Then we multiply that. We're going to multiply that by the total number of shares that is in the subsidiary, and the total number of shares from this particular working 2 here, which we can also find within the separate financial statements here, which is this 50. Okay, so that is 50, and then we are going to multiply the result, this result, by the market value of one share within the subsidiary at the date of acquisition, and that has been given to us to be $29.60. Okay, so that's $29.60. So I'll come here and write 29.60. Okay, so that is what expand this for you to see. So I'll come here and do my calculation. That is going to be 0.220% times 50 times 29.60 0.60. So that is the fair value of the non-controlling interest at acquisition date. That becomes our fair value, and then we are going to add those two figures together. So I'll have my sum here, and then I'm going to add these two figures together, close my parentheses and hit enter, and that gives me the value that we have paid for the business as a whole. Now, what is the value of the business's net assets? What is the value of the net asset of the business? And that can be found using workings 2. So within our workings 2, so quickly I'll come here and then I'll write W2. Alright, and that figure is this particular figure we have here. This particular figure here. Come here and then I'll refer to my figure, which is 200. Now the difference, what's the difference? The difference now becomes the goodwill at acquisition. The difference between the value of the business taken as a whole and the fair value of the net asset at acquisition becomes our goodwill at acquisition. So that's is equal to this minus this, and then we have that figure there. However, let's go to the additional information again. We have been told in additional information 3 that goodwill has been impaired by 200,000 since the date of acquisition. So as I said, goodwill is not amortized. It is an intangible asset, but it is not amortized. Rather, it is tested for impairment loss, and any impairment loss is used to reduce the value of the goodwill at acquisition. So we'll have impairment, and that is 200,000. Alright, and that is 200,000. So the difference between the goodwill at acquisition minus the goodwill at the impairment loss gives us this particular figure, which we are calling our goodwill at reporting date. So that becomes our goodwill at the reporting date. So let me increase the font size of all of these areas. Alright, so for easy visibility, so this is our goodwill. Now this is measurement of the non-controlling interest at fair value. When I'm measuring the value of the business, of the non-controlling interest of the subsidiary at fair value, the treatment of impairment loss in the NCI calculation and the group retained earnings is different. However, for goodwill, it is always subtracted from the goodwill at acquisition to get our goodwill at the reporting date. So this is how we calculate our goodwill. The only complication with goodwill calculation comes at the fair value of the consideration, which we are going to look at in our next video. So the fair value of consideration can come in various forms, and we are going to look at that in our next video. So stay tuned. Continue to stay tuned to my channel. If you have not subscribed to the channel yet, please subscribe to the channel, and you will receive each and every video when I release them. Alright, so let's continue. Let's continue to now the non-controlling interest. So let me just shorten it NCI, which is actually acceptable form. So the NCI, first of all, we start by the fair value. So you have the fair value at acquisition. Whenever I say acquisition, I'm referring to acquisition date, at the date of acquisition. What is the fair value at acquisition? This can be found in workings. We got it right. Workings 3. You got that right. So as we can see, this value can be found right here. That is the fair value of this fair value of non-controlling interest. So we get that right from there. And then we are going to have a share, the NCI will have a share of the, so we have NCI share of the post acquisition, which I will shorten as this, of the post acquisition profits of the post acquisition profits. So what is the share of the NCI? The NCI percentage is 20%, right? And then we are going to multiply that by the post acquisition profits, which we found in workings 2 to be 1 million here. So I write my 1 million there. But since we are dealing with 3 zeros at the top, let me just put my 200 right here. Alright, so I can add those two together. Now listen to me carefully here. We are going to share the NCI, the impairment loss. There has been an impairment loss here. We are going to share this loss between the non-controlling interest and the group retained earnings. So the non-controlling interest will take its share of the impairment loss of this 200 here, and then the group or the parents will also take the 80% of this particular 200,000 impairment loss that we have here, because we are measuring the NCI at fair value. As I said, there are two ways of calculating the NCI. We have the fair value method of calculating NCI and the proportionate share of the identifiable net assets. When we are calculating net non-controlling interest at the fair value, what we do is that we share any impairment loss between the NCI and the parent, or which is the group retained earnings, in proportion to their shareholdings. So we come here. There is a reason for that, and I'm going to explain that in a moment. So we'll have our impairment loss, and that is going to be the 20%. I'm doing this for understanding purposes. All right, the 20% multiplied by 200, which we can find in workings 3. All right, so we have that. So what do? I'll have this so that it becomes a negative. I'm subtracting it, so it becomes a negative figure there. So I have minus 0.2, that is 20%, multiplied by 200, and then I'll have 40 here. So that when I add these two together, when I add this to this, I can get my non-controlling interest figure. So let me just make this 40, so that I will have this particular figure minus the impairment loss to get my non-controlling interest at the reporting date. So this becomes our NCI at reporting date. Now let's go to the fifth working, which is the group retained earnings. So this is the group retained earnings. With the group retained earnings, we start off by taking 100% 100% of the parents' retained earnings, that's RE, and that is how much from our calculations or from the separate financial statement. It is what 1150, and then we will have the parents share of the post acquisition profits, and that is going to be the 80% multiplied by reserve, which is 1 million. All right, so I'll just come here and write that. So I'll have 0.8 multiplied by 1000, and that gives me 800, and then I can add these together, and that gives me 1195. And then, as I said, the remaining share, we have shared 20% of the impairment loss, so the remaining is going to be allocated to the goodwill. So we will have here 80% instead of 20%, and then I can quickly have that equals 0.8 multiplied by my 200, and that will give me 160. So the difference between these two figures is going to give me my retained earnings, which I can put in a normal bracket there. So this becomes our group retained earnings, and this figure is what we are going to use in our consolidation to complete the consolidated financial statements. Now, let me explain why we allocated the impairment loss between the two figures. Now, the reason why we are doing this is because the NCI is being measured at its full value. So in other questions, you will see, instead of seeing this, let's go to my additional information. Instead of seeing the NCI is measured at fair value on acquisition, you can see the NCI is being measured at its full fair value. That is because it is containing the entire portion, okay, of its value in the business. So any impairment in the goodwill, okay, the impairment of the goodwill is going to affect the NCI because a portion of the goodwill is contained in this particular NCI figure, the 496 that we are having here. A portion of this goodwill figure is contained in this one. That's why we are calling it the at its full value. At its full value, that includes its goodwill portion. So if the goodwill is impaired, that means the non-controlling interest is also impaired. All right, so that is why we are sharing the goodwill between the group retained earnings and the NCI. I hope you get it. All right, so that is it. Now we continue, and then we are going to fill up the gaps within the consolidated financial statements. So now that we have our goodwill here, we are going to just put it in there. So what is our goodwill? That is from workings 3, as we have here. So I'm going to put it in there, and then we'll have our figure. Let me put it in double underlined. Good. So I'm sorry for the large gap within the figures. Bear with me. It's because of the expansions that I did, so excuse me for that. All right, then we also have the group retained earnings, which we have already calculated, so I'm going to link that to my group retained earnings, and that is 17 this, that, and then the last one is a non-controlling interest. So the non-controlling interest is going to be the same thing as we did. So what's the non-controlling interest value? That is 456. So I'll put that, and then I can sum these three figures together. Sorry, so we did a mistake here. So we did a mistake here. The parents retained earnings. I know you have identified that. Sorry for that. So the parents retained earnings from the separate financial statements here is 2,600. It's 2.6. I think I used the one at for the subsidy. So sorry for that. So that's the parents. That is 2,600. So as soon as I change that, this changes my figure for me, and so I have my consolidated financial statement fully balanced here. So I can come here and then I'll put this. Let me put it. Come here, put this. So this is how we prepare a simple consolidated financial statement. This is simple, but it lays the foundation for all the key tricks that you need to understand so far. So this is the measurement of the NCI at fair value. Now, when it comes to the measure at a percentage of the share, let's look at the question here. So what I'll be doing is that I'm going to copy the solution that I have for this particular question. The solution is going to be the same. So let me just copy this. So let me just copy everything. I'm going to copy this, and then I can paste it here. Good. So I've pasted it there, and then the only difference now is going to be, so guess what? What will be the difference? The difference here, this is the NCI at being measured. So as you can see, the note 4 is saying all the other things are the same except the note 4, which is that NCI is measured at a proportionate share of the identifiable net asset of the subsidiary at acquisition date. So when that happens, then the calculation for NCI and then the group retained earnings will change. Then remember, the calculation for goodwill, NCI, and the group retained earnings are going to change. The rest remain the same. That to do is I'm just going to copy the workings for my goodwill, up to the workings for the group retained earnings. So I'm going to copy this. Let me quickly expand this. So the other workings for the other workings are going to remain the same, so we are not going to do anything about them. So we have this, the cost. So we'll have this being the same. The goodwill, which I've referred, is going to change. The retained earnings is going to change, and then the non-controlling interest is going to change. Good. So now we have the same thing set up. The only difference is going to come for our goodwill, for our non-controlling interest, and then the group retained earnings. So let's see how that is going to be done. The cost of investments remains 1,200. Then the fair value of the non-controlling interest. So now we will not have the fair value of the non-controlling interest, or the value of the non-controlling interest will no longer be measured at this as this, but rather is going to be 20% multiplied by the value of the net assets of the subsidiary at acquisition date, and we found that to be 200,000. So I'll write my 200 here. Let's go and check that out. So as you can see, this is 200. So this is the value of the subsidiary at acquisition date, 200. All right. Then, so we are going to use that against our figure here. So I'm going to have 0.2 multiplying the 200 here. This is how the share of the non-controlling interest method of measuring NCI works. All right, the share of the net assets of the non-controlling interest works. This is how it works. All right, so that's what we are doing. So this changes our figure, and then the fair value of the net asset at acquisition remains 200. All right, so this is 1040, and then we have the impairment loss of 200, so that our goodwill becomes 840. So quickly I can come here and link my goodwill, which is 840. Come and link it here. So we have our goodwill perfectly set up for us there. Now we continue to the fair value of the non-controlling interest. Now, what's the value of the non-controlling interest at acquisition? As I have already used Excel to refer to the formula used here, changed my figure for me to 40, and that is perfect. And this is from workings 3. All right. Then the NCI share of the post-acquisition profits remains the same, 200 remains the same. Then we have 240 as the addition. Then the share of the impairment loss will not be here. This is where the trick comes. So that will not be there. So I can actually delete this particular row there. Alright, so that will not be there. And then this figure becomes our NCI at reporting date. So I'll cut this and paste it here. Right, so this becomes our NCI at the reporting date. Now, why is it so? Let's calculate the group retained earnings and then I'll explain. So with the group retained earnings, we have the 100% of the parents as usual. We will have the parents' share of the post-acquisition profit, which is 800 as usual. So the sum gives us 3,400. Then with the impairment loss, everything is going to be attributed to the parents. The entire impairment loss, which is 200, is going to be attributed to the parents. Let's insert those figures into our consolidated financial statements so that I know that we are done with this particular video, and then I'll come and explain the treatment later. So our group retained earnings is 3,400, 3,200, sorry, as we have there. So I'll link that, and then my non-controlling interest is 240. Link that. So as you can see, the consolidated financial statement balances perfectly. Now, using the explanation I used at the NCI, measuring the NCI at fair value at the acquisition date, comparing that with the measurement of NCI at the proportionate share of the identifiable net assets. These net assets here, alright, the net assets in the net asset schedule, the figure, this 200 figure here, is excluding the goodwill portion. Okay, it is excluding the goodwill portion of the our goodwill calculation. So since it is excluding the goodwill portion of it, if goodwill is impaired, we do not have to attribute any impairment loss to the NCI. So the NCI is right now, it is not at its full value. That means it does not include the goodwill element, and so we do not include the impairments, and we do not adjust it for any impairment loss on our goodwill. I don't know if you get it. So that is the reason why we do not apportion impairment loss when you are measuring to we do not apportion impairment loss to NCI when we are measuring NCI at its proportionate share of the identifiable net asset. The identifiable net assets do not include goodwill element. That is why we do not share impairment loss to NCI when you are measuring the NCI at the proportion or the percentage share of the identifiable net asset. On this note, I hope you have learned the basics. Now, as I said, when it comes to goodwill calculation, the complication comes when we are measuring this particular fair value. The fair value can come in various forms. All right, it can come in various forms. It can come as cash or any other form of consideration, and that can be in the form of share exchange, deferred consideration, and contingent consideration. They can combine all of these in a single question. So in my next video, we are coming to look at how to deal with each and every one of these different forms of consideration that a parent might give for acquiring a subsidiary. Thank you very much for your attention. I hope you have learned a lot in this video. Please subscribe to the channel.